Well, hello, and welcome to Corporate Central Credit Union's August monthly market monitor, excuse me. Uh, my name is Wade Cooper, financial strategist. I'll be the host today. I'm going to give this another couple seconds and get moving. Um, I think, all right, we're going to start it. So, well, let's just start with the inverted yield curve. So we've been watching this, obviously, the entire industry, I think, has probably been watching this since it happened in October of 22. But you can see the dramatic, um, and what I'm going to do here is, I know we've all seen this before, but I want to talk about the market first, and then briefly about the interest rates and some other things, but more so the effect on the credit union industry, um, and specifically liquidity, because when I talk to credit unions on a daily basis, and on a daily basis, the conversation is about liquidity. So let's talk about how we got there here. You can see, obviously, so we have the interest rates. The Fed funds is the red line. 3-month treasury is the blue. 2-year treasury is the green. 5-year is the yellow, and the 10-year is the orange. So you can see the path that we have. This goes back 5 years, the second quarter 18. But you can see, let's just go to first quarter 2020, COVID, all that good stuff. Feds dropped the rate. We're sitting at almost zero for a while, and then just a complete spike um, over a year. And again, it was October of 22 where we inverted. So you can see that the 3-month sitting right on top of the Fed funds, and where we're at today, both of those are above the 2-year, which is above the 5-year, which is above the 10-year. And we'll we'll talk a little bit more about the effects of that on credit unions here in a second. But I talk about this quite a bit with credit unions as well, because I work with them on the investment side. How does the curve turn to normalcy? And you can see down here, the blue line is May of 21, where we had a normal curve, and June of 23, where inverted. So what I always, the credit unions that have some cash that to put towards investments, the question is, if you're sitting at the 2-year or 3-year, and you can get a 5% CD, you're getting a nice spread there, and we find those on Simply CD. You have a nice spread. The question is it going to be, if this was a treasury, you'd be going up the yield curve, so you'd actually be losing value. The value of it would go, you'd eventually get it back, but the value would go down as you roll up the curve. Where in May of 21, if you're at a 3-year and the 3-year turns into a 2-year, you're rolling down the curve, and the value goes up. So it's an interesting question, because we don't know. We're going to be talking about what the expectations of Fed cuts here in a second. But how does this return? Does the long end go up while this craters? Do they move kind of in tandem? This goes up at the same time this goes down. Does this just absolutely crater down here as this stays put? Nobody really knows what's going to happen, but that's, eventually we want it to look more like this. We just don't know how it's going to happen. So on the investment side, that's always, I can make the argument, well, it's a great spread right now. And if you get 5% for 2 years and federally insured money, that sounds pretty good. But we don't know the effect of your balance sheet because we don't know exactly what's going to happen with the yield curve. So let me talk about waiting for a recession. Because of when you talk about the yield curve and the inversion, there's always been, well, I should say, every recession there's been, it's been preceded by a inversion. So you can see the stats here. Now it's a small sample set, but it goes back to 1969. Again, our most recent yield curve inversion, October of 22. The all years average is 9.8. Well, we're at about 10 months from this date. So we're sitting at the average right now for a recession. And let me make it clear, I'm not rooting for a recession. Of course, there are some doomsdayers out there who, Chicken Little, sky is falling, we're going to have a recession, and it's almost like they're rooting for it. Recession is going to happen eventually because it's part of the business cycle. So we just don't know when, and it could be, again, the average is 9.8. The averages are getting longer. If you look at the average prior to 1985 is 8.2 months. And then after 85, 11.5 months. So the average, again, getting longer, averages all years 9.8, almost 10 months, that is. But who's to say we're not going to break, the longest is 16.5 months. Who's to say we're not going to break the record and it's going to go 2 years? We don't know. But while we're waiting, the Fed is going to do what the Fed is doing, and they're right now fighting inflation. You can see July of 22 was the peak. It's been coming down. We all know that, we just saw what happened to the Fed funds rate during this time and how it's been going up. Inflation sitting at 3%. Still above the Fed's stated goals, which we will get to in a second. Unemployment, the other part of the dual mandate. Throughout all of this, we never hit 4%. Their mandate is it's about 4.1% that they want to keep it under. And we're sitting at 3. We never went above 3.7. So, if you look at October of 22, that's when the inversion happened. We were sitting at 3.7% unemployment, but inflation was still at 7.7. So they had to keep rising. They had to keep raising. They have all the data, so they had to keep raising, and a raise they did. But the unemployment is staying pretty steady. Now, I found in my research for this presentation, I did find an interesting slide, and this is employment numbers, not unemployment, but employment numbers. You can see U.S. employees on non-farm payrolls. The last 6 employment numbers that came through have all been revised downward. And I found it interesting. I thought I should share it. I don't know if I should be reading too much into it, but it's, to me, it just makes sense to at least pay attention to something like that. because the numbers come out and then say, oh, well, maybe they weren't as good. Okay, so what else isn't as good? What else are we missing? Um, Again, not rooting for the recession, but you would think that if employment numbers don't stay strong, that there's something to it. And here's back to the Fed's dual mandate. Um, their dual mandate bullseye, uh, roughly 4.1 is the unemployment on the bottom here, core inflation on the side, um, roughly 4.1 and 2% inflation. We're sitting at about 3.5 unemployment and about 3% inflation. So we'll star on the map. We're getting there. Before this star would have been off this off this chart. Would not have even hit the board of the bullseye. So it's moving in the right direction. This is the FOMC dot plot. So this is this is the prediction of the Fed, which I always find interesting that, I don't like predicting the future. They're trying to predict the future, and they have this dot plot, and but you can see at the end of 23, so we're sitting at about 5.3 right now. The end of 23, so this is the median. This is all these yellow dots are voting members, and where they think it's going to land. The median is the green, and the Fed funds futures is this white line. So the green is the median where everybody thinks we're going to land. They think it's going to be above 5.5, and we're sitting at 5.3 and some change right now. So they still think we're going to go up a little bit by the end of the year, and then start coming down to somewhere between 4.5 and 4.75 next year. So that is 4.5 to or roughly 5.5 to, maybe if we just go downward revision to 4.5, that's 1 point of cuts this next year. The Fed funds futures thinks it's going to be more drastic than that. They're looking for just below 4% in a year, so they're thinking cuts all year too. Which again, they're both moving in the same direction, so at different rates, of course. But a year ago, we were not seeing this. The Fed funds futures were much more optimistic about the cuts than the Fed members were. But they look like they're kind of, I mean, and keep in mind the Fed members, they have all the data, they have the lever. So I would, well, I don't want to take any sides here. They're both moving in the same direction. It's just a matter of where they end up landing. But as Mark Twain said, if you find yourself on the side of the majority, it's time to pause and reflect. Fed funds futures. This is the data that the Fed funds futures are using. Again, this is kind of this would be the white line. This is the data from the white line. We're at 5.3 roughly now. They're looking to go up by the end of the year to 5.4. And then the cuts all the way down. And if we look at the end of 24, 12, 18, 24 of that meeting, they expect to be at 3.95. This is the graph of all of that data. So you can see a slight rise and then a whole bunch of cuts going down. It's hard to, maybe that's going to be interesting to see if they can pull that off. Now, if a recession hits, they might have to lower it, and maybe it'll look like this. if unemployment spikes, um, it's possible. Um, but again, um, it's difficult to predict the future. So I want to talk about how this is affecting credit unions. And I'm going to start with the cost of funds. And again, this is a Callahan chart. If you have Callahan, and the data they didn't get all the second quarter data in before I made my slideshow. So I apologize. I don't have the most recent, but you get the idea here. Red line is the cost of funds for credit unions. And this is all credit unions. Every slide I'm going to use is all credit unions. So I'm not picking on a peer group or anything like that. This is everybody. We're all in this together. So the blue line 3-month treasury, again, you can see during 2020 how low we were, and our cost of funds were actually above that. And then rates started going up, and ours, there's a bit of a lag there, that now our cost of funds is starting to go up. But this you know if rates go up 100 basis points, your cost of funds can't automatically go up 100 basis points, because of that'd be an awful big squeeze on you have loans sitting back. Well, I'll get to the lag here in a second, but you can't, just because rates go up 100 points doesn't mean you're going to raise your members' shares up 100 points. You may move them up a little bit, but and that's starting to happen, and you can see that there was a bit of a lag there. The other, not only are we talking about changing or raising share account, the yield in your share accounts. It's also, again, I talk to credit unions a lot about, CD specials. They don't want to raise their rates, their cost of doing business. They don't want to raise their own cost of doing business. So CD specials where they may not attract the new money that they want, but they're keeping their price sensitive, their yield sensitive members. They're keeping the money there. So you're playing a little bit of defense there. You can also see recently this kind of a jump in borrowing. So borrowings to assets. This is, again, all credit unions. So right when the spike did start, when we started going up in the rates, that's when the borrowings, and we're hopefully just leveling off here a little bit. Not that borrowing's a terrible thing, but we're seeing a lot more of it industry wide. And again, we get these calls quite often about revisiting their line of credit and extending it if they can. So that's again the effect of what's going on in the market, in the larger market, is affecting what's going on here. And it's also the rates are higher to borrow. So again, that's going to have an effect on this line and this number. As the rates go up for borrowings, of course, then the rate, the amount of borrowings to assets is going to go up. So the loans to assets, again, this is the effect of liquidity. And again, we talk about liquidity on a daily basis here. We go back, well, this went back 10 years, but I kind of wanted to show that you can see the pattern. Kind of peaked here in fourth quarter 18. There's the peak and the trough, then all this craziness, in 2020 started happening. All this cash hit the books. And of course, if the cash is landing on the assets, your denominator is getting bigger. Loans might not be keeping up, so you have a drop in the loan to assets, and then the free money kind of stopped. So the cash started running out, but the loans didn't seem to slow down. So now we got cash flowing out. Well, this was cash flowing in still, and we kind of leveled off. Now the cash is flowing out, but the loans didn't stop. So now uh, the denominator is getting smaller, and the loans keep growing, and we're almost back to the peak. And this is the 2-year comparison of all credit unions. I think we got to add a few zeros on here but you get the point. The assets, cash balances from first quarter to 22 to first quarter of 23, down 35%. All the cash was going out. Total investments, again, uh, people would have a laddered maturity. Instead of reinvesting, they needed the cash. So all the investments are the loan port or the investment portfolio is going down. However, the loans didn't stop. They're up 18% over that time period. And then, total assets 4.84. So as an industry, we went up, but the loans really, really spiked, and the cash all drained out. So, when the cash drains out and the loans don't stop, what happens? You need the borrowing. Um, you get the squeeze. It's hard to raise your cost of funds, um, even though you need to keep that money in there. So similar to the uh, cost of funds, there's a lag in the yield on loans, and you can see we were pretty consistent for 4 years or so. I mean, keeping it pretty straight line here. So this is the yield on loans. Blue line 6-month Treasury, green line 3-year Treasury, um, yellow line 20-year Treasury. So if we're talking, let's say car loans, um, car loans, sometimes credit unions look at the average life might be 2.5, 3 years. So let's look at the 3-year Treasury versus that. But you have a nice spread here um, between that and even especially the 6-month. A very nice spread going. And then the spike happened. The spike in rates happened. And our spike, we couldn't raise our rates as quickly as the spike happened. Now, anecdotally, I did see a lot of credit unions who probably should have raised their rates faster than they did. But again, as an industry, um, if you're sitting in the third quarter of 21 and you put in, this is roughly 4.5%. And you put a car loan on at 4.5%, well, that's most likely still going to be on the books. So this is still on the books here. So that is in the equation. We're starting to see it pick up now, so that's good. Need to get over the 6-month Treasury rate. That would be and start seeing some spread again. Because again, six-month Treasury would be risk free. But again, not saying we did anything wrong or bad or anything like that. Just that's when rates spike like this, it's hard to catch up. You can't catch up overnight. You can't. And if I'm talking about, I only got 5 minutes. I'm sorry. I'm running out of time here. If I'm talking about loans, I'm going to talk about some delinquencies. So, when I was a regulator and credit union would have delinquency issues, it was from a management perspective, it was usually one of two things. It was either an underwriting problem or a collections problem. And the third one would be kind of outside of that's what a credit union can control. Outside of their control would be, say, if they had a SEG and it was a plant in town that shut down or had a bunch of layoffs, or if it's a union-based credit union and all their members are laid off, that's beyond their control as well. But the first thing we would look at it would be underwriting and collections, to see if there's any problems there. Collectively, we can't say that with this chart. These are all credit unions. So again, if we look at first quarter 22 to the fourth, again, there's peaks and valleys here, or troughs. So it always peaks, or usually peaks in the fourth quarter. Fourth quarter goes down, peak in the fourth quarter. This is 2020, so things kind of get goofy, but you still see the peak in the fourth quarter 2020, fourth quarter 21, little peak. Then it goes down. The concerning part here, that I see is the rate of delinquency from first quarter 22 to the fourth quarter 22, because we were looking at about 0.42 and we went up to 0.61. And again, that's collectively, that's the entire industry doesn't have an underwriting problem. The entire industry doesn't have a collections problem. Something else is happening, because it hasn't been that much of a jump within that time frame. If we go back to first quarter 19 to fourth quarter 19, it was 57, I believe, versus 70. So it was still 13 basis point jump, but not 21 or 19, I think it was. So that's actually roughly 50% more than what we saw back here. So that's a little concerning. I just wanted to point it out, because we'll just have to keep an eye on it, because that'll affect earnings. I'm going to now say thank you for joining us. If you have liquidity concerns, because that seems to be the everyday what we are hearing about, we have several things we're doing. We just rolled out a new liquidity framework review that might be helpful for your credit union. Take a look at your policies if you have secondary lines of credit, things like that. I know the NCUA just came out with a letter regarding liquidity. Of course, if you want to revisit your line of credit here, we can help with that. Non-member deposits through Simply CD. These are all ideas we can help out with you. I do have to mention, and former regulator, ALM, keep an eye on your ALM. If you haven't had a validation in a while, best practices every 5 years. If you've changed providers, then within 2 years, it's good to have a validation on that. And that's something we can help out with too. But don't want to get too salesy here, but just wanted to make sure everybody knew that those are some of the things we can do. I'm going to jump off. I'm getting close to my time. Wade Cooper, financial strategist. Please give us a call if you need anything.